excited to have Matthew Sullivan here with me. Welcome, Matthew.
Hey, Tom. Thanks for having me on.
Absolutely. Matthew is the host of Hooked on Startups, a podcast series, and you help out a lot of entrepreneurs who are learning in business, experienced entrepreneurs, pretty much a gamut. And it is, I love your podcast, and that's been great. And you're also the co-founder and co-manager of the Secured Real Estate Income Fund.
Exactly, that's right.
Yeah, and so you've got quite the interesting background. I know you and I have had a chance to talk quite a few times about different things, and just be interesting for you to share a bit about yourself, if you wouldn't mind.
Sure. So I'm originally from the UK. I moved over to California about 3 years ago. Mm-hmm. My background is very much entrepreneurial. I've run my own businesses for almost 30 years, and I've been involved in a number of sectors, telecoms, stockbroking, finance, technology, software development. I spent 5 years working very closely with Richard Branson and was involved with a range of projects from Virgin Jeans, Virgin Clothing, Virgin Helicopters, Virgin Jets. I was a director and trustee of the London Air Ambulance. So over the years, I've had a lot of experience in startup companies and also, I guess, sort of investing in other startups, other businesses, and other mainstream and alternative investments. So I've been exposed to a whole range of different experiences.
Wow, some exciting things there. No wonder you're hooked on startups is a great way to share all the knowledge and experience that you have. So
thank you.
So when you got started, what would you say were some of the things that you learned early on, or maybe just share some of those experiences that you had early on in investing, and what took you down the path that you chose?
Well, the thing about being an entrepreneur is you tend to have a very defined view of yourself, and you have this desire really to make the business work. And that works when you're in control of your own business. But when you're investing in other people's businesses, or you're investing in other types of investments like stocks and bonds and shares, you don't have that same level of control. And so the one thing that I always try to do with the benefit of experience is spread or sort of diversify my investments, because learning from my mistakes, some of the biggest mistakes I've ever made in investing have been from where I've put all my eggs in one basket, and where I've gone in. What do they say? Fools rush in where angels fear to tread.
Right.
So the mistakes I've made have been based on just putting everything into one stock or one property or one investment. Secondly, not doing enough research. Just thinking, don't worry, it'll be okay. And that works if you're an investor in your own business. Because you're in control of that. So the trouble is, if you take that mindset and apply it to investing in someone else's company, then you have no control. So if things start going sideways, you can't step into a public company's business and explain to them how they should be running their company. So you then end up just going with the flow. So so my investment approach has become much more conservative over the years, where I will now, if I invest in stocks, which frankly I'm not at all enamored with stocks, even though the upside might be a lot higher, because I really don't know what's happening with the markets, and because I am much more of a subject to the ebb and flow of market sentiment. I tend to be much more focused on alternative investments now, where I can get to understand the underlying investments. I can maybe meet the managers if it's a fund or if it's an investment strategy. I can see the investment itself. I like to touch and feel things much more. So,
sure. So you touch on a couple of things there. So if you were to sort of describe what you believe are your way of investing, do you typically try to diversify between active and passive, or can you maybe describe a little bit of what you would just share a little bit of what you do
Sure.
with your portfolio between the sort of the active where you're really involved with it, or the passive where you're maybe the stocks or
Sure.
fund.
Okay. So there's investments in companies. So I no longer make investments in other people's companies, and the reason for that is because I was an entrepreneur. I then moved from being an entrepreneur to investing a small amount in other people's companies. And the problem with that is, as an entrepreneur running your own business, you are in control of everything. You define the policy and the direction of your particular business. If you're a minority investor in someone else's business, then you have very little say in what goes on. And the reason you're investing in that person's business is because you trust their management ability and you trust their vision. But you find yourself having to sit on your hands or button your lip. Because there are many things that you see and you would do differently. So it becomes quite frustrating, really, to invest from a minority position in someone else's business. And the other thing is that the amount of time it takes, the amount of time that you dedicate to someone else's business is probably equal to the amount of time that you would dedicate to your own business. So you don't get that leverage effect. And what happens is, because you don't have control over someone else's business, the statistics, which are pretty well known, is that most businesses will fail for a number of different reasons. So not only are you not really getting that leverage effect, if you're an entrepreneur and can do it yourself, you're also increasing your exposure. But this really only applies to someone that would normally like to go and run the business themselves.
Yeah, and so just on that, when you are talking about investing in other businesses, is that specifically businesses, or is it real estate and business, or is it what's
two separate things? Okay, so there's the equity investment in a business. So a guy comes and says, "Look, I've got this great idea," and I go, "Yeah, I think it's a great idea. I'll put a little bit of money into your business," and then you hope that you'll get the 10x when this idea takes off. I mean, normally what happens is that you'll get a cash call a few months later where the business plan didn't go according to plan. And then you either decide whether or not you write off your initial investment or you put more in. So that's the equity side, but you're going for the 10x or the 100x situation. So there's the risk adjusted return there. But as I said, I just don't do that anymore. And the reason for that is that I've learned that the only way that I'm going to get that 10x or 100x is if I do it myself. Or if I'm incredibly lucky, and I would much prefer not to rely on luck to define my investment portfolio. So I'm a recent investor in real estate, and I mean sort of over the last sort of 3 to 5 years. And the reason for that is that I've always avoided real estate because I've always thought that I want to get those 10x returns. I want to get the racy returns. And I've always really failed. Those types of investments have failed to live up to expectations for about 100 different reasons, but mainly because the investments are outside of my control. They're subject to market fluctuations, market sentiment, and all sorts of things happening to a business that were not forecastable. So my investment mantra now is look for a solid return base with potential upside. And the great thing I love about real estate is it's an asset class that is not correlated to the stock market. So that means that if the stock market dumps one day, the value of my real estate collateral is not going to dump the same day as well. And I like the fact that if things go wrong, there's something there that I can rely on to sell, something that has intrinsic value. The
security, right.
And there are, the more I looked into real estate, it's not just debt. It's not just, you don't make money from real estate just by buying a property and selling it. There are 100 different ways of making money from real estate, but still leveraging that solid asset base. And whether it's very low risk debt at one end of the spectrum, or you've got the slightly higher risk equity, or as the leverage increases, you get a better return. But
is there any one of those that you prefer to aim for? Is it long-term buy and hold? Is it rental?
Well, I'm not an active investor. So my investments are, I don't have time or expertise to be an active investor. Mm-hmm. And I don't want to learn on the job, and I don't want to make expensive mistakes. Mm-hmm. So the only way that I would get involved directly in a single property is as part of a consortium with other people. But the issue there is that I think I would run the risk of having that exposure to one particular property, which
diversification.
Exactly.
Yeah.
So, and I think it's a function of age and experience where, I tried all these different things thinking that they would all work out. And, and some of them did. And I've made money and I've lost money in third-party investments. And I am most comfortable with real estate. And I'm most comfortable with with real estate as a defensive play. Mm-hmm. And I've just stopped being greedy. Mm-hmm. And I'm looking much more for long term. So what I want to do is take a yield, or I want to know that I've got some sort of earnings, because I like the idea of cash flow, but I also like the idea of having some profit. So, for example, I would invest in a debt fund, or like which is why we put our fund together. But mm-hmm. The thing that is most exciting for me is having some forecastable yield. And then if I want to crank up the risk reward, I can maybe move up the capital stack towards the equity, or I can start looking at more junior positions.
Sure.
But I've always got the ability to have that as part of a balanced portfolio. So I don't have, I would not put all my eggs in one basket again.
I see. Okay. I remember a while back we were talking, and I believe you said your father was in the banking business?
Yeah. Many years ago, he was one of the original senior officers at Manufacturers Hanover, which was, back in the 70s, I think.
Mm-hmm. And did you, any advice you got from your father, or anything that you recall? Because that would have been when, I'm sure that's where you learned some of your lessons for investing, or maybe not.
It's funny, actually, no, because you would imagine that, but I think the reality was that because of the long hours that I think probably most people in that sector, because it was such a rapidly expanding sector. I can remember, my dad leaving in the morning when it was dark and getting home very late at night when it was dark. And I think the last thing probably that he wanted to talk about was anything to do with work. Okay. And so but I think what I got from my parents was this sort of entrepreneurial, the buzz, but would I take advice from anyone? Probably not, because I was so headstrong and, at an early age, I knew everything at such an early age.
Right.
And I think what I've done is spent the last 30 years actually, unlearning all that stuff and trying to figure out.
I see. So let's kind of take it from there then. The things that you did initially early on, anything that comes to mind that you might share with listeners as to what are some, like a nugget or two that a new investor or somebody who's, I believe there are a lot of investors that have some cash, they're looking to invest something into some sort of an investment, but how do they know, what's your take on how to get them to feel comfortable with where they might invest, or whether they are passive investors or active investors, or that whole thing?
Okay, so first of all, do your research. Mm-hmm. So it's a balance between research and analysis paralysis. So at the moment you've got cash, it's sitting in a bank account, it's doing nothing for you because it's in cash. So your money is actually going backwards. So if you're okay with that, that's fine, but most people aren't. Mm-hmm. So you want to do something with your money, but my experience and where I am now is I don't want to lose any of it. investment.
Yeah.
So, beforehand, I've lost a lot of money. And if I think about it, it makes me cry.
Mm-hmm.
And I could have avoided losing that money with some very simple, tips. And as I said earlier, don't put everything in one place. So you've got a certain amount of cash. What do you want from it? Think about what your risk reward profile is. What sort of an investor are you?
Mm-hmm.
Are you very risk averse? Are you happy to make some risk? Do you want income? Are you happy to wait for a number of years for the capital appreciation? So figure out what you want from your investments. I did none of this. I just basically threw money at various different things.
Mm-hmm.
And now it's about saying, well, if I'm going to control my own portfolio, which we're talking about here, I'm not talking about going to a financial advisor
Mm-hmm.
saying, here's some money, do it for me. If I'm going to do it myself,
Yeah.
I want to have a small number of investments that I really know about. And those are typically, I would prefer to do things that are on my doorstep.
Mm-hmm.
Where I can go and kick the tires, or I can go and see the buildings. And I would like to do it in real estate because it's something that's conservative, dependable, asset-backed, and it's something that I feel familiar with.
Mm-hmm.
And so my learnings now is look for maybe 4 or 5 different types of investments.
Mm-hmm.
Do your due diligence on the managers if you're putting money into a fund.
Mm-hmm.
I think funds are a great idea because they spread your risk across lots of different properties. But there are dozens and dozens of very well managed alternative funds that are not mainstream, that are run by very capable guys that have a very strong track record.
Mm-hmm.
So don't feel you have to go mainstream. Try and, is there a local investment community, for example? There are various meetup groups. And the way that I learned about US real estate is by going to meetup groups, by going to local organizations and meeting people who had invested.
Mm-hmm.
And so I think that's the advice that I would give is be prepared to make investments yourself.
Mm-hmm.
Don't worry about making that leap, but get the advice and counsel of other people and work with people that have done it before so that you can learn from their mistakes.
Mm-hmm. So you talk about the sort of the, and I'll paraphrase, the paralysis, the analysis paralysis, all the way through to the risk profile, like what risk. Do you have any thoughts or any advice to listeners on, for instance, 2 questions. One is how to get out of that analysis paralysis if one is in that, and secondly, if there is a ratio that you recommend, like let's say that there's a higher risk and a lower risk. Do you subscribe to any sort of a ratio that you think is ideal of how much to put into maybe a little bit higher risk, how much into a lower risk?
Yes, I mean, my rule of thumb is not to put more than 10% of an investment into anything, into any one investment, not necessarily any one sector,
mm-hmm.
but I don't want to commit. And that comes from hard-won
and that's
experience.
10% of what of the available capital to invest.
Yeah, so if I got a portfolio of whatever it is, not to commit more than 10% into any one, mm-hmm. into the same investment.
Yeah.
And if you're looking at stocks, and the issue with stocks is I have no idea where stocks are going to go. And I think mm-hmm. anyone that says they do is a genius, frankly, because there are so many external factors that you can't predict that change the price, and there are wild fluctuations. So that's scary.
Well, and it seems like we're playing with a lot of professionals that.
Yeah, and you're basically I like to invest in things where I can see the edges.
Mm-hmm. Yeah.
And with stocks I can't, because there are so many better people there that are much better at me at that particular type of investment,
and probably have a lot more data to make their investment decisions on than anybody.
Exactly.
Anybody else. So.
And my experience is that, in any investment, there are winners and losers. There are mm-hmm. people that buy and people that sell. Mm-hmm. And I've always been, I haven't been enough on the winning side of investing in stocks to make it compelling. So that's my sort of 10% rule, which is not outlandish, because I think, that's a fairly well-known rule. Mm-hmm. But the other part really is to avoid analysis paralysis is just do something, make an investment.
Mm-hmm.
Now it could be a few $100s, but just make an investment in a sector that you're considering, because that will focus your mind. And if you've made that step forward, then you're committed. I'm not saying bet the farm. I'm just saying put a small amount in, which could just be the minimum, just so that you then feel that you've got that connection, because then you will become much more interested and connected to what the investment is about.
Yeah. And so advisors, coaches, people that might know, any thoughts on it can be pretty easy to get caught up in too much coaching and too much advice, too many different sources of information. But on the other hand, I think it can be really valuable to get the right type of advice and coaching. So any thoughts on that?
Yeah, I think there are a lot of courses, and there's a lot of real estate tuition in particular, where if you're not careful, you can end up spending more in tuition than you would have done on your investment. And I think some of these are great, some of these are not so great. But I think if you're going to go down that route, you've got to decide from the beginning, are you going to be an active or passive investor? Mm-hmm. If you don't have the appetite to be an active investor, if you can't see yourself being the person that owns the building, or you can't see yourself as being the landlord, then it's probably not worth going to the time and expense of going through all this training to do a deal that you're never going to do. So look yourself in the mirror and ask yourself a very serious question. Are you the sort of person that is going to be the active investor?
Yeah, even if the potential returns are said to be great.
Yeah, because you probably won't.
If it isn't what you really want to do and are passionate about and will enjoy.
Yeah. So if it's not, and that is the biggest question to ask yourself. Understand who you are as an investor, what you're comfortable with and what you're not comfortable with, and only look at things that you're comfortable with, and don't try and fool yourself that you will be able to learn this, because you will end up spending tens of thousands of dollars. You'll become an education junkie. Yeah. You'll go to all these conferences, handing money over to probably perfectly good companies. But because of your limitations, you won't make that investment. Mm-hmm. So that's a very poor return on investment. But the other thing is to spend time looking at management companies and the track record of existing funds. Mm-hmm. Because that's, I think, if you're a passive investor, acknowledge the fact that you're a passive investor, leverage other people's experience. Mm-hmm. You're not going to get the same stratospheric returns, but again, your risk is limited. So just figure out, and maybe the time that you spend in the education process should really be about spending time understanding who you are, what your approach is, so that you can then match your real investment approach to the types of investments that are available. Yeah,
and so it certainly is a matter of sort of personality types and what we feel like we can do and are passionate about or want to do. But there's also the thing about, is it cash flow that somebody is looking for? Is it longer term gain? So that could be another deciding factor on the type of investment.
Yes, but again, spend time. Again, I'm just talking about real estate here, but there are other types of investment clubs, whether it's investing in startups or investing in stocks, bonds, shares, any of the other types of investment asset classes. Find local groups, local meetup groups, local education groups. Go from a word of mouth recommendation if possible, because that's the best. And just do some research. Don't rely on professionals exclusively, because you won't necessarily get the full story. I think investment advisors and brokers do a brilliant job, but I think if you've got time, don't rely necessarily on their advice. Try and find some tips, tricks, and tactics from some other people that have been down your path, because that'll just help broaden your investment horizons.
And you bring something up there that's really interesting and I think really important, and that is when, regardless of what it is, if it's in investing or whatever it might be, almost in life in general, is to understand the motives behind what someone is telling us. So, and not like it's necessarily an ulterior motive, but it's like if somebody is giving me advice on something, it's good for me to know what perspective they're coming from. So yes. if I potentially can earn a big commission on something that I'm giving someone advice on, that's a lot different than if I'm totally neutral and giving advice on maybe a project that somebody has brought to me that I have nothing to gain, nothing to lose, but I can just really share my advice with, like, some of the people I mentor, where I can really come from a neutral perspective versus if something is being sold or whatever. So understanding the motives behind it, I think, can be really valuable.
It is. But again, coming back to analysis paralysis, it's very easy to assume that no one's giving you advice unless they want something out of it. So you can actually sit back and not do anything because you think that the whole world is really trying to sort of squeeze some money. But that's not the case. I think take on board that people are motivated to steer you down a particular path because of what's in it for them. And you take that on board because that's the way the world works.
Yeah.
But that's why I think it's important to meet people that are in the same position as you, who have actually done that type of investment. And I'm not talking about investments in something that is very distant, like stocks where you have no control. But if you're thinking of becoming part of a real estate syndicate, then talk to other historical syndicate members, and don't be too afraid of dealing with people where there is a vested interest, because in some ways you actually want that, because if someone is motivated to make your investment successful for them, then that's something that you can leverage for yourself as well.
Sure. That's good point. And I think that, having that transparency or the track record, if you're able to get that from the person that you're working with, that's certainly a way to make sure that there's,
and the more you do this, the more experience you get, the more confident you become. So that's why I think it's important to start. It's like anything in business, really. You don't get anywhere unless you've actually started. So, and again, we're talking about a hybrid almost between passive and active investing, where your investment is a little bit passive and it's a little bit active. And you've got this sort of balance between the two. So as you become more experienced and more confident, you might want to get more involved in something that is more active, where you take more of a role because you feel that you've got more experience in that.
Okay. Any thoughts on, for instance, retirement accounts, or any advice on?
Well, no, I don't. I mean, I'm the worst person really to ask for advice on retirement accounts, because my, there's obviously, I mean, speak to your advisor, basically. Gotcha. But I think that tax efficiency is absolutely critical. If you can set your investments up in vehicles that are tax efficient, then why would you not do that? So spend time thinking about the tax implications of your investments, whether it be depreciation or whether you're able to delay or not be exposed to income or sort of normal income tax. The thing to do is spend time and money, if anything, with professional advisors who can tell you how to structure your investments, because you may end up saving yourself a fortune in capital gains tax or income tax, which will make a significant change, positive change to your returns.
Sure. Good. Okay. If you, let's see, any particular advice you'd give, like any resources, any special, like any book that's a favorite of yours, anything that our listeners could walk away with and maybe be able to use as a resource?
Yeah, I think there's a number of resources, but the most important thing really is to be completely at ease with what your investment objectives are. And understand what sort of person you are as an investor. And that will really help you follow the right path and not making and stop you from making investments that ultimately you become very uncomfortable with. Because the last thing you want is to make an investment and then have it cause you sleepless nights.
Yeah. It would really help narrow it down too. So the what is it? The confused mind says
yes.
no. So
you're right, exactly. So if you're confused, if choice is confusion, if you have all these different options, then you're going to say no, and you're going to keep your money in cash, and you're going to end up continuing to go backwards each year.
Yeah. So doing anything you can to really define what it is what is your best path, what's going to make you feel the most comfortable, whether it's a risk profile, whether it's a strategy, all of those things, trying to narrow that down as much as possible, and then take action once that has been narrowed down.
Absolutely. And I'm just talking about your book, for example. And I know that the premise behind your book, The Bank-Free Blueprint, is really all about laying bare the methods and the processes of investing.
Yeah.
And what comes out of the fact that it's not a terribly complex business, but the critical thing is for an investment manager is being able to work with people that deliver.
Yeah.
So, and that itself is just the magical thing. So, it's actually a lot simpler than you think, but I think all of the books really just the key theme with most of these books is just focus on one particular sector, become knowledgeable and experienced in that sector, whether you're an investor, passive or active.
Yeah.
But the more experience you have in the sector, the more of the more feeling and sixth sense you get.
Yes.
For deals, and the more practice you get, then the better you're going to become, which means the more solid and predictable your investment returns will be.
Right. Excellent. Well, great. So Hooked on Startups, and I understand you have a book that let me just say, if anybody would like to reach out to you, get a hold of you, how might they do that? And maybe just share, I understand you have a book coming out as well.
Sure. Well, the book is called Head First, which is a guide for modern entrepreneurs. So it's really a distillation of all of my experiences and all of the places where I went wrong, and also a lot of the real gems that I picked up from some of the people that I've been interviewing over the last few months. So that's work in progress. So don't hold your breath if you want to get that.
Yeah.
But I also have a real estate crowdfunding site, which is crowdventure.com. So if you want to contact me, my email address is msullivan at crowdventure.com, and all the other contact details there. Or there's the website, which is hookedonstartups.com. So you've got a choice of crowdfunding or startups, or so whatever takes your fancy.
Yeah, and definitely I would suggest any of the listeners to certainly take a look at the Hooked on Startups podcast site. I've listened to some of those interviews, and they've got a lot of really good nuggets in them. And so
that's very kind.
I think the value that really comes from that is being able to learn from someone else who has either made mistakes or has dodged things.
Exactly.
And so anything that we can do to reduce the risk on whatever we're doing, whether it's real estate or any sort of startup, anything that we can do to reduce risk, it not only protects our investment, but it makes life so much easier, so much more fun, so much less stressful when we can learn from others and just be able to avoid a lot of those things. So
yes, exactly.
So I want to thank you, Matthew, for joining me on this. Really appreciate it, and we'll catch up again soon.
Wonderful, Tom. Thank you.
Thank you.